U.S. life annuity insurers increased private credit holdings by 6% in 2024, with the level doubling over the past decade as their appetite for publicly traded investments remained flat. That according to a new AM Best report. We're joined today by the report's authors, Associate Director Jason Hopper and industry analyst Kaitlin Piasecki. And Kaitlin, we're going to start with you today. The report explains that insurers have been in this private placement space for decades. What's changed during this time?
So following the great financial crisis, stricter regulations and higher capital requirements were placed on banks. So that led these traditional banks to then take a step back from commercial lending. So then non-bank lenders such as private equity firms, investment management firms, they stepped in to fill this gap. And that's what really led to more issuance of private credit. Also during this time, interest rates were very low and they stayed low for more than a decade. So that left insurers in search of higher yielding assets such as private credit.
So how has that changed the market over the past few years?
So as you mentioned, insurers have been investing in private credit for decades, but the type of issuer has continued to shift. Issuer obligations, which is direct lending to companies, have made up the majority of private credit allocations, and they still do. But these allocations fell from 77% in 2014 to 58% by the end of 2024. So now we're seeing a shift towards non-mortgage-backed securities. That's up by 17% since 2014. And then driving the growth of structured non-MBS, it includes middle market CLOs, as well as private structures backed by traditional collaterals, such as credit cards and autos.
Jason, are there specific risks that AM Best will be keeping an eye on going forward?
Yeah, so there's a couple of categories of risks that we do take a look at. You have company risk, right? You have issuer risk and macro systemic risk, right? From the company side, we look at credit and illiquidity as more of this exposure gets ramped up on companies. You also have exposure growth, right? And you have competition and aggressive pricing. On the other hand, some mitigating factors, proper asset liability management, you have surrender protection, a lot more new annuity money coming in is now under surrender charge protection. Private credit offers diversification amongst issuer as well as segment. And on the liquidity front, you have FHLB access for just-in-time liquidity. On the issuer risk side, you have questions around valuations or spreads or terms and conditions, defaults, collateral. But on the other hand, companies do stress test their portfolios. And there's well-known managers that have been in this space for a long time that have track records, right? And then the macro systemic risk, you have potential asset bubbles, lack of regulations, kind of things like that. So those are kind of all the areas that we're looking at when we do our analysis.
Thanks, Jason. Kaitlin.
Thanks, John.
That was Associate Director Jason Hopper and industry analyst Kaitlin Piasecki. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.